Let me ask you a question that will reveal everything about how you think about investing. If someone told you that starting tomorrow, you could only own 3 stocks for the next 10 years, no trading, no adjustments, no changes, just 3 companies that you had to live with through thick and thin, what would you choose? Most people freeze when I ask them this question. Their minds race through hundreds of possibilities. They panic. They second guess themselves. Because when you strip away all the noise, all the daily trading, all the market timing, all the complexity that Wall Street wants you to believe you need, and you force yourself to choose just 3 businesses, that is when you discover what you truly understand about investing. I have been investing for over 70 years. I have analyzed thousands of companies. I have made billions of dollars, and I have made costly mistakes that taught me lessons worth more than the money they cost. And if you told me today that I could only own 3 stocks for the next decade, I would not hesitate. I would not need weeks to decide. I would not need to consult analysts or read reports or wait for the perfect moment, because I already know. I know because these 3 companies represent everything I have learned about what makes a business not just good, but truly great. Not just profitable today, but nearly certain to be more valuable and more dominant 10 years from now. And today, I am going to share those 3 stocks with you. But more importantly, I am going to share why I chose them, because the specific names matter less than the principles behind the choices. And if you understand those principles, you will be able to make better investment decisions for the rest of your life, whether you own these exact 3 stocks or not. Before I reveal the 3 companies, let me tell you what I am looking for, because most investors get this completely wrong. They look for stocks that will go up the fastest. They look for companies in hot sectors. They look for technical patterns on charts or momentum or whatever the financial media is talking about this week. That is not investing. That is gambling. And over 10 years, gambling always loses to genuine business ownership. When I am choosing businesses to own for a decade, I am asking completely different questions. First, will this company exist 10 years from now? You would be shocked how many well-known companies fail this basic test. Second, will this company be more dominant, more profitable, more essential to its customers 10 years from now than it is today? Because if it is just maintaining its current position, inflation alone will erode your real returns. Third, does this company have a genuine economic moat? Something that protects it from competition, that gives it pricing power, that makes it nearly impossible for rivals to steal its customers. Fourth, is management competent and honest? Because over 10 years, you are essentially entering a partnership with whoever is running this business. You better trust them with your capital. And fifth, this is the one most people miss. Can I understand this business well enough to have conviction when things get scary? Because I promise you, at some point in the next 10 years, the market will crash. Panic will spread. Experts will predict doom. And if you do not deeply understand why you own what you own, you will sell at exactly the wrong time. Those are my 5 filters. And only 3 companies pass all 5 filters with such overwhelming strength that I would be comfortable owning nothing else for the next decade. Let me tell you about the first one. The first stock I would own for the next 10 years is Apple. Now, I know what some of you are thinking. Warren, Apple is already one of the largest companies in the world. It is not going to double or triple from here. How can this be your top choice? And that reaction tells me exactly why most investors fail. Because you are thinking about stock price movement instead of thinking about business quality and sustainable wealth creation. Let me explain why Apple is not just a good investment, but one of the finest businesses ever created, and why 10 years from now, it will be even more dominant than it is today. I have said many times that the iPhone might be the best business I have ever seen, and I mean that literally. Think about what Apple has built. Over 1 billion people carry an iPhone, not because they have to, because they choose to, even though iPhones cost more than competing phones. That alone tells you something profound about the value Apple creates. But the iPhone is just the beginning of why this business is so extraordinary. Apple has created an ecosystem. Once you are in, you do not leave. You buy an iPhone, then you buy AirPods because they work seamlessly. Then you buy an Apple Watch because it integrates perfectly. Then you buy a MacBook because everything syncs. Then you subscribe to iCloud because your photos and files are there. Then you buy apps from the App Store. Then you subscribe to Apple Music, Apple TV Plus, Apple Fitness. Then you use Apple Pay for transactions. Then you save with Apple Card. Every single product and service makes every other product and service more valuable, and every single addition makes it harder for you to leave. That is not manipulation. That is genius business design. It is an economic moat so wide that no competitor can cross it. Samsung makes fine phones. Google makes decent software. But neither of them has an ecosystem that comes close to what Apple has built. And that ecosystem generates the most beautiful business model I have ever seen. Recurring revenue, every month, over 1 billion people pay Apple for services. Not once, every month. That revenue is predictable, high margin, and growing faster than hardware sales. 10 years ago, Apple's services revenue was barely noticeable. Today, it is bigger than most Fortune 500 companies, and it is still in the early stages. Now, let me tell you what Apple's going to look like 10 years from now, because this is what most analysts completely miss. The iPhone will still exist, but it will not be the main story. The main story will be Apple's transformation into a healthcare company, a financial services company, an automotive technology company, and an artificial intelligence company. All built on top of that ecosystem foundation. Apple is already quietly building healthcare capabilities into the iPhone and Apple Watch, fall detection that saves lives, heart monitoring that detects problems before they become emergencies, sleep tracking, fitness monitoring. Over the next decade, the Apple Watch will become the most important medical device in the world. It will detect diseases earlier than doctors can. It will monitor chronic conditions constantly. It will save millions of lives and generate tens of billions in recurring revenue from health services. Apple is already a major force in financial services through Apple Pay and Apple Card. 10 years from now, especially outside the United States where banking systems are less developed, Apple will be one of the largest consumer financial institutions in the world. Processing payments, providing credit, managing savings, all seamlessly integrated into devices people already trust and use every day. Apple is developing autonomous vehicle technology, not to sell cars, but to power the transportation systems of the future. 10 years from now, Apple's technology will likely run in millions of vehicles, generating software and services revenue from every mile driven. And artificial intelligence will transform every Apple product. Your phone will not just respond to commands. It will anticipate your needs, manage your schedule, protect your privacy while personalizing your experience in ways that seem almost magical. And because all of this will be processed on device, rather than in the cloud like competitors do, Apple will have a massive privacy and security advantage that will only strengthen its moat. Here is what people miss about Apple. They think it is a hardware company that sometimes sells software. That is backwards. Apple is a services and experiences company that uses hardware as the delivery mechanism. And that business model, built on top of an ecosystem with over 1 billion loyal customers, is nearly indestructible. Could Apple's stock price be volatile over the next 10 years? Absolutely. Will there be quarters where iPhone sales disappoint and the stock drops? Certainly. Do I care? Not even slightly, because I am not buying Apple for the next quarter. I am buying Apple for the next decade. And I am buying the underlying business, not the daily stock price. 10 years from now, Apple will have 2 billion users in its ecosystem. Services revenue will be larger than iPhone revenue. The company will be generating over $100 billion in free cash flow annually, and it will have returned hundreds of billions to shareholders through dividends and buybacks. That is not speculation. That is the logical outcome of current trends, continuing with modest assumptions. So when I say Apple is the first stock I would own for the next 10 years, I am saying I want to own a piece of one of the best businesses ever created at a time when most of its best growth is still ahead of it, with management I trust completely, serving customers who are fanatically loyal in a position so dominant that no realistic competitor can threaten it. That is what great investing looks like. And that is exactly what I am doing. Berkshire Hathaway owns more Apple stock than any other position in our portfolio. That is not an accident. That is conviction based on understanding. Now, let me tell you about the second stock. The second company I would own for the next 10 years is Coca-Cola. And I can already hear the groans from younger investors who think Coca-Cola is boring, outdated, a relic of the past that will be disrupted by newer, healthier beverage companies. That reaction is exactly why most young investors stay poor, because they chase excitement instead of understanding business fundamentals. Let me teach you why Coca-Cola is one of the most perfect businesses on earth and why it will be worth substantially more 10 years from now. I bought my first shares of Coca-Cola in 1988. The stock has returned over 2,000% since then, not including dividends. And I have not sold a single share. Why? Because I understood something then that is even more true today. Coca-Cola does not sell beverages. Coca-Cola sells happiness in a bottle. Every day, more than 2 billion servings of Coca-Cola products are consumed somewhere in the world. 2 billion. Stop and think about that number. That is not luck. That is not marketing alone. That is proof that Coca-Cola has created something no competitor can replicate. An emotional connection with consumers that transcends logic, transcends health concerns, transcends price, transcends everything. When someone is thirsty, when someone wants a treat, when someone associates a specific moment with refreshment and joy, they reach for a Coca-Cola product. Not because it is the healthiest choice, not because it is the cheapest choice, because it makes them feel something. And feelings are the strongest economic moat that exists. Now, let me address the objections I always hear. Warren, people are drinking less soda because of health concerns. True. Do you know what Coca-Cola did? They now own Dasani Water, Smart Water, Honest Tea, Simply Orange, Minute Maid, Fairlife Milk, Costa Coffee, and dozens of other beverage brands across every category. Coca-Cola is not a soda company. Coca-Cola is a total beverage company that owns the number 1 or number 2 brand in almost every drink category that matters. When consumers shift away from soda, they shift to products. Coca-Cola also owns. The company does not lose. It just redirects you to another one of its brands. Warren, developing markets are getting health conscious too. That might hurt Coca-Cola. Wrong. Do you know what is happening in developing markets? Hundreds of millions of people are entering the middle class for the first time. And one of the first things people do when they get disposable income is buy branded products that make them feel successful. Coca-Cola is that brand. While soda consumption is flat or declining in wealthy countries, it is growing rapidly in Africa, in Southeast Asia, and South America.
Coca-Cola is positioning itself for decades of growth in markets that have billions of people still entering consumer culture. Here is what makes Coca-Cola so extraordinary as a business.
The product formula has barely changed in 139 years. The brand value has only strengthened. The distribution system is nearly impossible to replicate. And the business model generates massive free cash flow with minimal capital requirements. Coca-Cola does not manufacture most of its products. It creates concentrate, the secret formula, and sells it to bottling partners around the world who do the capital-intensive work of production and distribution. Coca-Cola captures the highest margin part of the value chain while pushing the lower margin, higher capital intensity parts to partners. That is brilliant business design. And it means Coca-Cola can generate enormous cash flow relative to the capital it needs to reinvest. That cash flow comes back to shareholders as dividends and buybacks. Coca-Cola has paid increasing dividends for 62 consecutive years, 62 years of raises. Through recessions, through wars, through market crashes, through everything, Coca-Cola kept increasing the dividend. That is not just a financial achievement, that is proof of business durability. Now, let me tell you what Coca-Cola will look like 10 years from now. The brand will be even stronger globally because they are investing heavily in marketing and sponsorships and creating associations between Coca-Cola and positive experiences. The product portfolio will be even more diverse, with healthier options, with functional beverages, with products that meet changing consumer preferences while still generating the profit margins that make Coca-Cola special. The distribution system will be even more efficient with technology improvements that reduce costs and improve service. And the dividend will have increased for 72 consecutive years, providing shareholders with predictable, growing income that few other investments can match. Some investors get bored with Coca-Cola because it does not move dramatically. The stock goes up steadily but not explosively. That is exactly what I want. I do not want excitement. I want predictability and compounding. I want a business that I can own without worry, that will be worth more every year, that will pay me increasing dividends, that requires almost no attention or concern. When I say Coca-Cola is one of 3 stocks I would own for the next 10 years, I am saying I want to own a piece of the most powerful consumer brand on earth, with a product people emotionally connect with, a business model that generates massive cash flow, a management team that understands capital allocation, and a track record of surviving and thriving through every challenge for over a century. Could something disrupt Coca-Cola? I suppose anything is theoretically possible, but I have been hearing predictions of Coca-Cola's demise for 50 years. People said video games would destroy it. People said energy drinks would destroy it. People said health trends would destroy it. People said private label products would destroy it. None of it happened, because Coca-Cola does not compete on logic. It competes on emotion. And emotions do not get disrupted. They get transferred to new products under the same brand umbrella. That is why I own Coca-Cola. That is why I will still own it 10 years from now. And that is why it deserves to be one of only 3 stocks in a concentrated portfolio. Now let me tell you about the third stock. And this one might surprise you because it is not a stock I currently own in significant quantity, but it is one I deeply respect and would absolutely own if I were building a portfolio from scratch with only 3 positions for the next decade. The third stock is Amazon. Let me explain why. Amazon is one of the most misunderstood companies in the world. Most people think Amazon is an online retailer. That is like saying Apple is a phone company or Coca-Cola is a sugar water company. It completely misses what makes the business extraordinary. Amazon is 3 businesses, each one individually worth hundreds of billions of dollars, all operating under one company structure. Let me break down each one and explain why Amazon will be far more valuable and dominant 10 years from now. First, there is the e-commerce business that everyone knows. Amazon has trained billions of people to expect fast, cheap, convenient delivery of almost anything they want. That expectation is now permanent. You cannot put that genie back in the bottle. And Amazon has spent 25 years building infrastructure that makes it nearly impossible for competitors to match their service at their cost. Warehouses, fulfillment centers, delivery networks, logistics, technology, all of it creating a moat that gets wider every year. But here's what most people miss about Amazon's retail business. Amazon is not trying to make money on the products they sell. They are trying to control the transaction. Every purchase on Amazon, even from third-party sellers, gives Amazon data about what people want, when they want it, how much they will pay, what they buy together. That data is worth far more than the profit margin on any individual product, because that data allows Amazon to optimize everything: what to stock, where to stock it, how to price it, what to recommend. Amazon's retail business is essentially a massive data collection engine that happens to make modest profits while building unmatched competitive advantages. Second, there is Amazon Web Services, which most consumers do not even know exists. AWS is the backbone of the internet. Netflix runs on AWS. NASA runs on AWS. Tens of thousands of companies run their entire operations on AWS. And this business generates profit margins that make Amazon's overall financials look completely different than people expect. While retail operates on thin margins by design, AWS operates on extraordinary margins, because once a company builds their infrastructure on AWS, switching is so painful and risky that almost no one does it. This is a business that is growing rapidly, generating massive cash flow, and has enormous competitive advantages. Cloud computing is still in the early stages of adoption. 10 years from now, virtually every business on earth will run on cloud infrastructure. And Amazon will be one of 3 companies that dominate that market. The revenue and profit from AWS 10 years from now will be larger than most companies' total valuation today. Third, there is the advertising business that almost no one talks about. Amazon knows exactly what you are shopping for at the exact moment you are ready to buy. That makes Amazon's advertising more valuable per impression than almost any other platform. When you search for running shoes on Amazon, showing you a running shoe advertisement is worth far more than showing you that same ad when you are scrolling social media, because intent matters more than attention. Amazon's advertising business is already over $40 billion in annual revenue and growing over 20% per year. This is a business that will be over $100 billion in annual revenue within 10 years, advertising revenue that comes with almost no additional cost because the infrastructure already exists for the retail business. That is nearly pure profit, dropping straight to the bottom line. Now, let me tell you what Amazon is building that will define the next decade. They are building a healthcare business that will transform how Americans access medical care. Amazon Pharmacy is already delivering medications faster and cheaper than traditional pharmacies. Amazon Care is providing virtual healthcare services. Over the next 10 years, Amazon will become one of the largest healthcare companies in America using the same playbook they used in retail. Make it faster, cheaper, more convenient, and let the scale and data create unbeatable advantages. They are building an entertainment business that competes with Netflix and Disney. Prime Video is not just a perk to keep Prime members subscribed. It is becoming a standalone competitor that uses Amazon's massive cash flow from other businesses to invest in content at levels most competitors cannot sustain. 10 years from now, Prime Video will be one of the top 3 streaming services in the world, generating revenue from subscriptions and advertising while keeping people locked into the Prime ecosystem. They are building out physical retail through Amazon, Go Stores, Whole Foods, and other concepts that blend digital and physical shopping in ways that traditional retailers cannot replicate. Amazon is using stores as distribution nodes, as showrooms, as data collection points, not as the primary business model, but as extensions of the digital ecosystem. And they are building financial services. From Amazon Pay to business lending to insurance products, Amazon has hundreds of millions of customers who trust them and shop regularly. Extending that relationship into financial services is obvious and inevitable. 10 years from now, Amazon will be one of the largest consumer financial companies in the world.
Here is why Amazon would be one of my 3 stocks for the next decade. Amazon is playing a different game than everyone else. Most companies try to maximize profit margins.
Amazon tries to maximize long-term free cash flow by investing aggressively in customer experience and infrastructure. That strategy means Amazon sometimes looks less profitable than competitors on paper, but it also means Amazon is building moats that cannot be crossed. Every dollar Amazon invests in warehouses, in technology, in content, in new business lines, is a dollar that makes the overall business more valuable. Because everything Amazon builds reinforces everything else. You buy from Amazon Retail, which makes you more likely to subscribe to Prime, which makes you more likely to watch Prime Video, which makes you more likely to use Amazon devices, which makes you more likely to shop more on Amazon. The ecosystem effect that makes Apple so powerful is exactly what Amazon has built in commerce and services. 10 years from now, Amazon will have over 1 billion Prime members globally. Those members will spend more per person than today because Amazon will offer more services they value. AWS will have doubled or tripled in revenue as cloud adoption continues globally. The advertising business will be generating over $100 billion in high-margin revenue. Healthcare will be a meaningful business line generating tens of billions, and Amazon will have entered several other markets we cannot yet predict, using the same playbook of starting with customer obsession and building from there. Could Amazon face regulatory challenges? Possibly. Could competition intensify? Always. Do I care? Not for a 10-year time horizon, because Amazon has proven for over 25 years that they know how to navigate challenges and emerge stronger. Jeff Bezos built a culture of long-term thinking that survives his transition to executive chairman. The management team understands that quarterly profits matter far less than building sustainable competitive advantages, and the track record speaks for itself. If I could only own 3 stocks for the next 10 years, Amazon would be one of them. because I would be buying a piece of the most customer-obsessed company in the world with multiple businesses that are each leaders in their markets, with a management culture that prioritizes long-term value creation, with competitive moats that get stronger over time, and with growth opportunities that most investors have not yet recognized. Now let me bring this all together, because choosing these three stocks is not really about the specific companies. It is about the principles of great investing. And if you understand why I chose Apple, Coca-Cola, and Amazon, you understand how to evaluate any business for long-term ownership. First principle: invest in dominant businesses with genuine competitive moats. All three of these companies have something competitors cannot easily replicate. Apple has its ecosystem, Coca-Cola has its brand and emotional connection, Amazon has its infrastructure and data advantages. If a company does not have a real moat, it cannot deliver superior returns over a decade because competition will erode any profits. Second principle: invest in businesses you can understand well enough to hold through volatility. I can explain Apple's business model to anyone in 5 minutes. I can explain Coca-Cola's value in 1 sentence. I can explain Amazon's strategy clearly. If you cannot explain why you own something simply, you will panic and sell when the stock drops. And over 10 years, every stock will drop significantly at some point. Third principle: invest in businesses with multiple ways to win. Apple does not depend only on iPhone sales. Coca-Cola does not depend only on soda. Amazon does not depend only on retail. Companies with multiple revenue streams and growth opportunities are far more likely to thrive over long periods than one-trick ponies. Fourth principle: invest in businesses with strong free cash flow generation. All three of these companies generate enormous amounts of cash relative to the capital they need to reinvest. That cash either comes back to shareholders or funds new growth opportunities. Either way, shareholders benefit. Businesses that consume cash instead of generating it are poor long-term investments. Fifth principle: invest in businesses with management you trust. I trust Apple's leadership to allocate capital wisely. I trust Coca-Cola's management to maintain the brand and dividend. I trust Amazon's management to prioritize long-term value over short-term profits. You are essentially partnering with management for a decade. Choose partners carefully. And sixth principle: invest in businesses where the future opportunity is larger than the current reality. All three of these companies are more valuable for what they will become than for what they are today. Apple is becoming a healthcare and services company. Coca-Cola is becoming a total beverage company, dominating developing markets. Amazon is becoming a conglomerate of dominant businesses across multiple industries. The best investments are companies where the story 10 years from now is significantly bigger than the story today. Now, I want to address something important. Some of you are thinking, Warren, I do not have enough money to buy meaningful positions in all three of these stocks. Or, Warren, I want more diversification because 3 stocks feels risky. Let me be very clear about something. This exercise is about teaching principles, not prescribing a specific portfolio. Could I actually live with only 3 stocks for 10 years? Yes, because I understand them deeply and trust their competitive positions completely. Should you build a portfolio of only 3 stocks? That depends entirely on your situation, your knowledge, your risk tolerance, your time horizon. For most investors, owning a low-cost index fund that holds hundreds of stocks is smarter than trying to pick individual winners. I have said this many times: the average investor should just buy the S&P 500 index and hold forever. You will beat most professional money managers, and you will not lose sleep worrying about individual company risks. But if you are going to own individual stocks, if you are going to actively manage a portfolio, then you better understand what you own at a deep level. You better own high-quality businesses with real competitive advantages. You better have conviction that allows you to hold through volatility. And you better limit yourself to businesses you genuinely understand. Most investors own too many stocks. They own 20 or 30 or 50 different companies because they think diversification means quantity. But if you own 50 stocks, you do not really understand any of them well enough. And when trouble comes, and it always does, you will panic and sell the wrong things at the wrong time. I would much rather own 3 businesses I understand completely than 30 businesses I kind of know about. The concentrated portfolio is riskier in theory, but in practice, if you choose wisely and hold patiently, concentration builds wealth faster than over-diversification. Here is what I want you to take away from this. The exercise of asking yourself, if I could only own 3 stocks for 10 years, what would they be, is incredibly valuable. Not because you will actually limit yourself to 3 stocks, although you might, but because it forces you to think deeply about what truly matters in a business. It forces you to separate the good from the truly great. It forces you to distinguish between businesses you are excited about and businesses you would trust with a decade of your financial life. Most investors spend their time looking for the next big winner. They want to find the stock that will 10 times their money in 2 years. That is not investing. That is speculation. And speculation is a game designed to transfer money from the impatient to the patient. Real investing, the kind that builds lasting wealth, is about finding great businesses and holding them long enough for their competitive advantages to compound. It is about resisting the urge to trade, to time the market, to chase performance. It is about understanding that getting rich is easy, but staying patient is hard. If you owned Apple, Coca-Cola, and Amazon 10 years ago and simply held them without selling, without trading, without worrying about daily price movements, you would have dramatically outperformed the vast majority of active investors. Not because you were smarter, not because you predicted the future perfectly, but because you owned great businesses and let time do its work. That is the only reliable path to wealth in the stock market. Find quality, have conviction, be patient, ignore noise, let compounding work. Everything else is distraction. Now, I am going to tell you something that might make you uncomfortable. These 3 stocks could all drop 30 or 40% next year. The market could crash. A recession could hit. Some scandal or problem could emerge at any of these companies. Does that change my thesis? Not even slightly, because I am not investing for next year. I am investing for the next decade. And over that time frame, the daily noise does not matter. The quarterly earnings do not matter. The analyst opinions do not matter. The only thing that matters is whether the underlying business becomes more valuable and more dominant. And I would bet every dollar I have that Apple, Coca-Cola, and Amazon will all be significantly more valuable and more dominant 10 years from now than they are today. That is not faith. That is analysis based on understanding competitive advantages, management quality, growth opportunities, and business models. I know these businesses. I understand their moats. I trust their trajectories. And that knowledge allows me to ignore short-term volatility completely. That is what great investing looks like. Not excitement, not constant action, just understanding, conviction, and patience. Most investors never learn this lesson. They spend their lives jumping from stock to stock, from strategy to strategy, from excitement to excitement, and they end up with mediocre returns and enormous stress. The investors who build real wealth do the opposite. They find a small number of exceptional businesses, they buy when prices are reasonable, and they hold for decades while the businesses compound. It is not complicated, but it is hard because it requires patience and discipline that most people simply do not have. So let me end with a challenge for you. Stop looking for the next hot stock. Stop trying to time the market. Stop listening to predictions about what will happen next quarter. Instead, ask yourself this question. If I could only own 3 businesses for the next 10 years, which 3 would I choose and why? If you cannot answer that question clearly and confidently, you do not understand investing well enough yet. And that is fine. Most people never do. But if you can answer it, if you can identify 3 truly exceptional businesses with genuine competitive advantages, and if you have the discipline to buy them and hold them through volatility, then you have everything you need to build substantial wealth. You do not need 50 stocks. You do not need complex strategies. You do not need to outsmart the market. You just need to own pieces of great businesses and let time work for you. That is what I have done for 70 years. That is what I would do if I started over today with only 3 stocks. And that is what I'm telling you will work if you have the patience and discipline to execute it. The choice is yours. You can keep chasing excitement and end up exhausted with mediocre returns. Or you can find quality, have conviction, be patient, and build real wealth. I know which path works. I have spent my entire life proving it. Now it is your turn to decide which path you will take. Choose wisely. And remember, investing is not about being right tomorrow. It is about being right over time. And over time, great businesses always win.